Okay, welcome back to the channel. This is going to be another strategy video. So if you're finding it difficult to be consistent, then this is a strategy that you can use. There's rules that you can follow. Learn this strategy, keep testing it, keep building your skill set, and be profitable with it. So you know how much I love the Asian range, and so this is another Asian range strategy. But before we get into it, I do just want to say, don't keep hopping around strategies. I know I make quite a lot of strategy videos, but that's just so that you can watch them and see which fits with your trading times, your trading schedule, and your personality. You know, whether you want to trade higher time frames, swing trade, day trade, scalp, whatever it is. So don't strategy hop every time I post a new video. Still, if you want to watch it and learn, and it can be quite interesting to see different ways people can trade, then definitely do that. But don't trade a new strategy every time I post one and just keep hopping between them, because that's not how you're going to learn. That's what I used to do when I first started trading. I thought the next strategy is always going to be the holy grail, and that one's going to work. The previous ones didn't work, but this one will work. Try and avoid that. If you're struggling with that and don't know how to stop, then send me a message. I can try and help. But pick one strategy, try it, and really develop your skills on that. If it ends up not working out for you, then you can go to a different one. That's fine, but really give it some time and effort and back test it, forward test it until you're confident on that. But enough of the rambling. Let's get into the strategy. So the first step you're going to want to do, I'll trade it on the 5-minute time frame again. I think that's a good time frame to use for scalping, and it works for me. That's what I use. But you're going to find your bias, and ways you can do that is either looking at the previous day, or you can look at higher time frame. You know, you can go to the daily time frame and get your bias from there. Mark up PD arrays, you know, your order blocks, your imbalances, fair value gaps, points of liquidity to try and find out where the market's going. So that's going to be your step one. Have a bias for your direction, and then trade in that direction. Once you got your bias, then you're going to mark up a reaction zone. What I mean by this is just an area, another PD array, basically just on this lower time frame. So it could be a higher time frame order block. You know, it could be 15-minute, hour, 4-hour order block that you're looking for a reaction from, or it could be an imbalance. You know, it could be a liquidity that you're waiting to get swept, on top of the Asian range liquidity that you're looking to get swept. That's something else that I should add to the rules. But you're looking for a zone that you think price could react from. So kind of like my other Asian range strategy video, that's kind of the most popular Asian range strategy on my channel, where you've got those 50-minute or whatever higher time frame supply and demand zones. That could be your reaction zone. But this strategy is different because you're waiting for confirmation now, and that's what I found to be better. I like that strategy that I used to trade, but I find that waiting for confirmation gives you a better win rate, which helps with your trading psychology and just cuts down the costs because you're trading less with a higher win rate. So that's why I wait for confirmation, which is the next step, and that is step number 3. And in the step number 3, you're waiting for displacement from your zone. So basically a strong reaction from it, leaving imbalance, you know, a big candle that shows a lot of volume or momentum has entered the market in the direction of your bias. Once you've seen that, I'll show you how to confirm that. Then you're going to wait for a pullback to either, you know, to the imbalance, to the supply demand zone, to the optimal trade entry, you know, 62 to 79% Fibonacci retracement that ICT teaches. And you're going to enter on that pullback, stop loss above or below the high or low, and then target 1 to 3. I think that's something I'm going to be moving towards as well. I normally target, you know, recent swing points where there's liquidity. I'm just going to try targeting 1 to 3, keep it consistent, and then you have a fixed risk reward, so you need a fixed win rate to be profitable. So with a 25% win rate, targeting 1 to 3, then you're going to be breaking even. And so anything more than the 25% win rate, you're going to be making profit. And you can go, you know, 1 to 2 if you want, and then you need a 33% win rate to break even. And anything higher than that, you'll be in profit. And that's something people don't realize, that a 25% win rate is quite low, and that doesn't sound like a very good strategy that wins once and then loses 3 times. But that's all you need to break even here. And so that's something you need to realize again as well, because those low win rates can really make you pessimistic about your strategy, and that can cause strategy hopping if your win rate is quite low. But again, enough rambling about that. I'll go into a textbook setup of this, and we can get into 3 chart examples. 2 of them won, and 1 of them lost. So overall, that's 5% up in 3 trades. So that's quite nice. Okay, so this is the textbook setup. Hopefully the drawing kind of makes sense and you can get past my squiggly line drawings. But basically, this is a textbook sell setup, and then a buy setup would look the opposite. So the first step is to find your bias. And the way you can find this is just by looking at, you know, previous days, you know, on the higher time frame, or just on the lower time frame, looking for displacement in the previous day. And what you're going to be looking for is imbalance, and basically just big bearish candles if you're looking for bearish bias, and big bullish candles if you're looking for a bullish bias. And if you see any of that with strong imbalances and strong break of structures to the downside, like here, then that's going to confirm that your bias is bearish. And you can also see liquidity sweeps. So over here, you know, this high got swept, buy side liquidity was swept, and then price pushed down. So that gives you an indication that the bias is bearish. And you can confirm this with higher time frame bias as well. You're looking for higher time frame supply and demand zones getting respected, and higher time frame just structure, looking for change of characters, break of structures, whatever it is to confirm your bias. And I'll make a video on that at some point. I'm going to be going in depth on a strategy that someone suggested to me on my Discord. So shout out to them, they know who they are, and hopefully that will help you look at market structure more clearly, and it will be a completely mechanical strategy that you can use to trade on using higher time frame bias and then lower time frame entries. So I'm going to be working on that, but I need to do some back testing and properly make sure that I know how it works before I can actually teach it to you. So we'll get back to this video. Basically, you can see bias is bearish. We've got that from a higher time frame, and just previous day price has been pushing down. There's imbalance and strong bearish candles showing us bias is bearish. Then step 2, we mark up our reaction zone. Marked up this zone because it took out liquidity and then crossed break a structure. So this is a nice bit of supply. And obviously on the charts you can see there would be an engulfing bearish candle, some imbalance, and that nice bullish order block maybe. That's basically what you can be looking for. It could also be this whole leg, this whole push up before the push down. But for now we'll just leave it as this tighter zone. Then you're going to mark up the Asian range. Look for the high in this case to get swept. And as it doesn't need to get just fully swept. It can just be broken, because you're going to be targeting towards the pull and draw on liquidity, which is the sell side liquidity below the Asian range in this case. And then, so step 3, you're going to be waiting for a displacement from your zone. So once price taps into your zone, you can set limits or set alerts, on the zone, so you can watch it when price taps into it. Then you're going to be looking for a displacement leg, or just some kind of reaction from this zone. It doesn't have to change character, that can increase your win rate, but you're going to miss out on more trades because a lot of time when you're trading during the kill zones, price can just make quick moves and not actually cause change of character. And once it's caused a change of character, it can just continue down and you'll miss out on your trade. So however you want to trade, I prefer just to wait for displacement, wait for an inversion FEG maybe, so you get bullish imbalance, bullish fair value gap, followed by a bearish fair value gap, bearish imbalance, whatever you want to call it. And then that shows you that there was a liquidity sweep because there was a strong push up, strong push down, and that shows that there was a liquidity sweep. Then you're going to look for your entry. So a few ways you can do this. You can look for a supply zone here that causes this push down, pull back to that, and then sell from there. You can look for imbalance, trade from there. You can trade for the 50% of the imbalance. You can, however you want to line it up, you can look for a bullish order block lined up with the imbalance and try and trade like that. However your confirmation is, that is always up to you if you want to trade your own way, but the simplest way is just look for supply and demand zones and trade from there. If there's not a supply or demand zone, you can look for the imbalance and trade from there. Or if you really want, you can wait for extra confirmation, wait for price to come into the zone, react from it, should give you a sign that you're going bearish, and then just enter at market, sell there, place your stop loss above the high, and then target 1 to 3. So that's steps 4 and 5, enter on the pullback, and then target 1 to 3. And what you can see here, that is the same in one of the examples above. If you targeted the Asian low, maybe price just didn't go all the way down there was some kind of reversal, and price took up and take out your stop loss. So that's why targeting 1 to 3 can be quite good. Sometimes 1 to 3 could be lower than the Asian range, and that's fine as well. But I find just targeting 1 to 3 is a nice risk reward to go with. This is the textbook setup, and I'll get into the 3 chart examples. Okay, hopefully you're enjoying the video. I just wanted to quickly mention the premium Discord group that I run for $4.99 a month or $49.99 a year. Will be going up at some point soon, but I want to keep it cheap as long as possible so that everyone can get a chance to enter it. But basically what I do is every week I will give you a weekly watch list breaking down on the weekly, the daily, and the 4 hour, and sometimes even lower, all the main forex pairs, NASDAQ, US30, gold, silver, and you can add to this as well. If there's any pairs you want me to look at, then I will give you a personal analysis. Any trades that I take, I will send through, and I'm currently tracking my profit and loss so I can share that with you and be more transparent. But this is where you can learn from my trading signals if you're interested in that. And there's also an educational section with private videos on all of these topics, so lower time frame entries, how to get your higher time frame bias, how to choose high probability supply and demand zones, and you can suggest topics for me to give in-depth videos on, and I'll get them out and then add to the list. And this is just going to continue to grow. And then any questions you have, that are stopping you from becoming a profitable trader, you can ask me, and I'll give you unlimited support to get you to where you want to be. So definitely check it out if you're interested. I think it's really helpful, and it's only $4.99, so you can try it for a month and then cancel if you don't like it. But yeah, let's get back to the video. Okay, so the first example we're going to be looking at is a short trade from Tuesday the 6th of February. I'm going to start by showing you my bias. So if you look at the previous day on the Monday, what we can see is that price was pushing down. Price swept the Asian high on this day as well, and then started moving down Monday the 5th. Down, pull back, down, and then it kind of just started to range as the volume decreases because the markets are closing. But what we can see is in this area, there's some zones that we can mark up. So potentially price could go all the way up to this London session point, supply zone, which is unlikely because if it does that, then price is probably going to reverse through it. But it's still just something we can mark up. The other things we can mark up, potentially this zone here, bit of buying before selling, that potentially you could call a pullback, potentially not. Another zone we can mark up is this area here. There's some imbalance below it, and everything else after that, it's been already tapped. Once you look at the Asian range, potentially we could have marked up this as well, but because it had been broken through, or tapped into at least in the Asian range twice, then there's less confirmation that zone's going to work out, and by the time the the London session, the London kill zone at 2 a.m. New York time had started, it broke through it straight away. So there was no reaction from the zone. But these are the zones we had marked up. If we replay then to the start over here, go to the 5 minute and just have a look and see what happens. We're going to be waiting for price to tap into one of our zones and then give us a reaction. So we can see the price had this aggressive move up into our zone. And remember what I said, when you get a strong push up and then a strong push down, it's potential liquidity sweep. You've got this inversion FEG, imbalance here, matching up with imbalance here. So that's going to be confirmation that we could short from here, and this is a potential trade opportunity. And the reason this zone is nice, on the 5 minute you can see a couple of bullish candles, liquidity, imbalance with these candles, and then imbalance to the downside. So again, this inversion FEG showing us there was liquidity sweep. That's a nice thing just to look for, to confirm your zones, and also it happened during the New York kill zone, New York open kill zone. But then once price tapped into it, into our zone, and created that displacement, if we go back to the steps, we're going to be looking for to enter on the pullback. So we've had our bias bearish, marked up our reaction zones, we waited for displacement from the zone, we've got that here with this imbalance over here. So then step 4 is to simply enter on the pullback. So where are we going to enter from? Well, you could enter from the imbalance, target stop loss there, target 1 to 3. That's a potential trade you're going to take in. If you want to get into all the trades and don't want these tight stop losses from the supply and demand zones, that's a trade you could have taken. It's quite nice, and we'll see if it plays out. If you want to go a bit more aggressive, you can target a little bit of indecision before the strong push down. And so with this trade, then you could target 1 to 3 and be out a lot quicker. When you're doing these smaller stop losses, obviously spreads are going to be a bigger portion of your trades, and commission, because the lot sizes are going to be bigger. But that's something you're going to have to consider, and that's why, even though risk reward and win rate can be quite nice with this strategy, a lot of your profits can get eaten and taken away by the small stop losses. If we let this play out, then we can see what happens when price taps into it and then pushes down and sells off. But like I showed in the textbook setup, if you target the Asian low, in this case, it didn't work out. In some cases it does, and you can get a high risk reward. But in other cases, price can have a reaction from somewhere else and then turn bullish. And that's what it did here. Would have taken us out if we were targeting the Asian low. But just to show what would happen if we entered on the imbalance, target 1 to 3, and still these would have played out with wider stop loss and still a nice risk reward. So that's one trade that you could have taken, and a nice strategy where all the rules are met, and we've got nice higher time frame bias lining up with our lower time frame confirmation. So that's pretty much the bread and butter of SMC, higher time frame confirmation with bias and then lower time frame entry. So if we stop this and go on to the next trade setup. So the next trade is on Monday the 5th of February that I want to show you. And if we do the same thing, on the 50 minute, just look at what previous day was doing. We had a big sell-off. And so we can look for areas for price to return to. It's unlikely price will come back up here, but we could still mark up that area. But I'll leave it for now because price obviously didn't return to that, because we're looking in hindsight, we can see a nice thing here. It's just strong push down. And if we mark that up, we'll mark up this whole bit of buying before the selling. There's a nice area here above the Asian high, and I don't know if price actually tapped into it. I can quickly check. So yeah, it basically just tapped, luckily. If you'd marked up this zone, then maybe you wouldn't have got an entry, or you would have seen once you saw price create displacement just below the zone, you would have had a look, maybe seen actually there was some buying here. But also this area is kind of spread out, I'm pretty sure, so might not be the most accurate area to use. But combining it with this strong imbalance after the zone, and Asian high being just below it, it gives clear confirmation that this is a nice point to target. Because even if the supply and demand zone you mark up maybe is incorrect, you still got the fallback of having Asian high and low liquidity. So we go to the 5 minute and grab our rules back. Then what we can see is that we had our bias, bearish. Explain that. We marked up our zones, and then we're waiting for prices tap into the zone and give us a displacement. And what we can see is exactly that. Asian high liquidity swept just into the zone. You've got this inversion FEG again, strong push up into it and then strong push down. Price returns to the supply zone and then sells off. So very simple. You mark up again wherever you want. You can mark up this zone because it's quite small. You can mark up this candle as well, because this kind of price is slowing down before turning around. So a lot of sell orders were being accumulated in this area here. And if you wanted to use the imbalance, then I suggest 50% for a trade like this, because the imbalance is huge and you don't want a huge stop loss, because then your 1 to 3 reward could end up being really long. And it probably would have played out here. It would have played out here, but it won't always. And you don't want those huge stop losses and risk rewards, huge take profit targets. So what you can do, if we go back to just the tightest stop loss, set your limit on there. Stop loss would be above the high as always, and just target 1 to 3. It got played out very nicely. And when you become more advanced, if you want to add a bit of discretion, you could target here. Oh, it's exactly 1 to 3 for the structure. But if the structure is slightly different, maybe 1 to 3 was down here, let's say, if that makes sense. Say this was 1 to 3 and this structure was 1 to 2.5 or 1 to 2.7 maybe, whatever your limit is. You could target the structure instead because potentially there's liquidity below here the price may react from, but that's adding more discretion. If you want to keep it simple, just stick to a 1 to 3. And it would have played out, even I should assume if you went straight from the imbalance, the 1 to 3 still would have played out as a very nice trade. So most of these trades obviously should close within the same day. Maybe in a few rare chances they don't, but from what I've seen, yeah, most of them close in the same day within a few hours normally. And that's how you kind of want to be trading, because once you've had a reaction, if you were right about there being lots of sell orders placed in this area, then it should sell off once it returns to it. And you can see again, once price taps into this zone, it sells off again. You get this inversion FVG again, push up, imbalance to the upside, imbalance to the downside, except in this case, there was no returning to this supply zone or imbalance. So that was the second trade. Hopefully that makes sense. And these were two very nice trades that played out for 1 to 6, no matter how you traded them really. But now I'll show you a loss, because losses do happen, and we'll get into that now. Okay, so the trade I'm going to be showing you is on Wednesday, 31st of January, and we're going to look at the previous day, Tuesday, for any bias. And what we can see, we don't want to zoom out too much. Yeah, potentially price has been coming down, but from previous day price action, it looks like price was coming up. Got lots of bullish candles here. You had potentially liquidity sweep and then price pushing up. And so any zones that we can mark up, the nicest one I see, aside from all the imbalance, is this demand zone. So we can call that demand, and it's right below the Asian low as well, so that's quite nice. Give us confirmation, potentially get a liquidity sweep of the Asian low, and then we get a confirmation and price pushes up. And our bias was actually right. Price did for this day go up. London had a push up, pull back, and then a little push up, and New York had a continuation from London's move, so decided to continue up. But if we go down to the lower time frame and continue with our steps, so our first step was the bias, which we got, and you can also see on the 5 minute our bias kind of, this day potentially it was a bearish day, the close below where it opened, but the most recent price action is bullish, and that's kind of what I've been using to test this and have a look. Obviously you can experiment with different ways to get your bias, and the best way to do it is either through actual just back testing or ideally forward testing, because nothing is the same as actually risking your money, even if it's paper trading, but ideally risking small amounts of your own money to trade it and see how you trade emotionally. But obviously only do that once you have fully back tested something and are confident in it. Otherwise it would just mess with your psychology even more. But anyway, step 1, bias done. Step 2, we've marked up a zone. Could refine it even more potentially, but this is the selling before the buying, so we'll leave that as a nice zone for a reaction from. Then you can wait for displacement from your zone, so that's what we get here. Right at the start of the kill zone, price before it was pushing down and then pushed up. You get an inversion FVG. Yes, it wasn't formed fully in the zone. Is that a problem? Maybe. Potentially that's why this trade lost, but potentially there was other reasons, and we don't need to go too in depth there. Sometimes you just lose. What we get then is a strong push up and a nice demand zone. This 5 minute zone before a strong push up, right at the start of the kill zone. So what would you do? You go long at the start of this demand zone and target a 1 to 3. So that's a very nice trade if it played out. Closed out quickly, and price continued higher. But what happened instead is we got taken out, unfortunately. Price just wicked below it and then went up. So potentially there weren't enough buy orders here, and this was just a trap to induce people to place their stop losses below the zone, and potentially we fell for it. But that's part of trading. Sometimes you are the liquidity, and people will make jokes and say, you're my liquidity, support and resistance, whatever that, like people will call you their liquidity. They're probably unprofitable traders, like everyone loses. Sometimes you are the liquidity, and that's okay. That's just how it goes sometimes. What you could do potentially, once you again add more discretion and become more advanced, you can see that price took out liquidity and then pushed up again, gave us another inversion FVG over here, and potentially you could enter from this new demand zone and go for your 1 to 3 for a very nice trade that played out quite quickly. They potentially could have even placed a stop loss less risky and gone for a 1 to 3 again. So these are nice trades, but what you don't want to do is get into the habit of chasing winners. Like if you lose a trade, you don't want to then try and, I guess, not chase your losses, maybe like try and recover your losses. You don't want to lose a trade and then try and get into another one riskily to try and win it back. So I suggest just sticking to trading once a day. But this is just to show you that sometimes if you do everything right, follow all the rules and have good experience, you can still lose, because that's just part of trading. And if you could win all the time, then you'd be hired by some big bank and trading millions and making millions. And yeah, that's not how it works, unfortunately. All you can do is find an edge and just trade it, learn it, improve, and keep finding new edges when the other ones stop working. And that's all you can really do. Just keep learning and keep trading. But hopefully this has been helpful. Hopefully you enjoyed it. Again, if you have any strategy suggestions or video suggestions, then let me know. I've got a few lined up that I need to work on, but any ideas, I still will add them to the log and try to get to them when I can. But yeah, hopefully you found this helpful. If you did, please do leave a like and subscribe to the channel. Otherwise, I'll see you in the next video.